Good evening, everyone, and welcome to a special late night edition of Chart This with Dave Keller. It's just before midnight Eastern here on Monday, April 7th. But welcome to the show. We are coming to you from a rainy but still quite beautiful Olympic Peninsula in Western Washington. We're here out for spring break. This is way later than normal. If you're tuning in live, I salute you for your resilience in doing so. We are going to talk about the markets. We're going to talk about market conditions and enjoy ourselves, hopefully a great deal, and make this a brief discussion about market conditions. But my plan is to share with you some charts, share with you a quick update on what we saw with the markets today, reinforce the fact that, in my opinion, we are essentially no real change from what we observed on Friday. What we did not get today on Monday was a significant sell-off, right? You had a very choppy, volatile session. The VIX remains incredibly high, actually moved even higher to around 47 today. The S&P was down. It was up at the end of the day, not much of a change, closing around 50-50, a little above there, 50-60 or so. But to be honest with you, I would say this is a short-term bounce at best within a downtrend that I would not be surprised goes lower than this. With that in mind, let's look at the charts. And again, appreciate you guys tuning in late or watching the replay or whatever. Good to have you here. All right, let's look at how things are playing out, or how things played out today. The S&P 500 ended up about 0.25% lower. That's not bad, actually, right? And you'll see it's not a great candle pattern or anything like that. And to be honest with you, the real story is that the S&P on an intraday basis almost got to that 50% retracement level. I do have a longer term chart of the S&P to share with you in a little bit, and you'll see that you'll see that level that I'm talking about. But closing back above 5,000, not a bad thing, right? But again, I would say the primary trend undeniably down at this point. The NASDAQ composite slightly higher, 0.10%. The Dow only down about 1%, right, to just below 38,000. So again, could have been much worse of a day. And over the weekend, when we didn't have any backing of the tariffs, right, we didn't have a back off on the tariff announcements because that's what some were speculating. Maybe we would get a wind back of the or a rollback of the tariff announcement over the weekend. Otherwise, there would be a Black Monday kind of sell-off, and it certainly felt out of the open that might be what happened. But again, some news that ended up being incorrect, suggesting that had happened. Then it was announced that wasn't. Created all this volatility in the first hour of trading. I feel like going into the close, no one knew what to make of it, so we sort of just chopped around in the midpoint of that range. Here's the VIX moving almost 2 points higher to 47. We can see the NASDAQ composite and the NASDAQ 100, the only things in the green here on the front page. Kind of an interesting observation that bond prices went down pretty big. Looking to see if bonds end up being kind of a safe haven here, right? When you have everything trending lower, you're sort of looking for what actually pushes higher. Wasn't bonds today. Bonds have actually been moving higher and certainly outperforming stocks here in recent weeks. But today, the TLT was down 3%. Interest rates all moving higher. So the 10-year yield right around 4.10, 4.15. The long bond yield just below 4.6%. The 5-year point slightly higher, around 3.8%. So we've seen bonds starting to come lower a little bit. I mean, one area of the bond market that's actually holding up a lot better than most is high yield bonds. And I have a chart of the HYG I think I grabbed to share with you here in a little bit. All right, looking at the commodity space, the DBC was down 1.6%, gold down 2%, and that's another sort of pullback in gold. I mean, there were sort of these themes that we've been observing from mid-February to late March. Now in early April, post-tariff announcement, everything's changed. I mean, so many things. Very few things look the same today as they did last Wednesday in less than a week. So many charts have changed character in so many ways. Gold arguably still very much a good place to be, especially on a relative basis. And I would say the long-term structure of that chart is still quite sound, but the GLD down another 2% today. So we are seeing a bit of a pullback there. Silver, interestingly enough, though, did end up about 0.25% higher. It was up a lot more out of the open, but ended up settling down to that point. Rest of the commodity complex down, particularly energy prices and energy stocks continuing to struggle. Now, cryptocurrencies have been super choppy. And over the weekend, you saw Bitcoin get all the way down to 74,500, which is the lowest point it's been at in quite some time, certainly so far this year. You can see as the at the point we're going live here, again, right around midnight Eastern now, 80,000 is where we're at for Bitcoin. So currently up about 1%, but that's only from where we were there. Over the last 24 hours, we saw a big rollover to sort of mid 70,000s before powering higher to around 80,000. Ether prices, same idea, sort of pushing higher, going after, sort of going into the equity market close and then soon after. All right, looking at the 11 S&P sectors, we can see technology and communication services. Those are the only two that actually finished in the green. And technology, the big winner today, up 0.6%. It was not a broad rally in technology. You'll see when we get to the market carpet, kind of mixed actually. There were some things that worked quite well, some things that did not. Even within the mega cap names, sort of Microsoft up, Apple down. So it really has ended up being, I feel like after the initial shock on a day like today, it felt more like investors being a little more thoughtful about which names and which types of names are potentially going to struggle here in this new world of tariffs, and which ones may be okay. So Apple with a big tie-in with China, of course, big revenue source there with the immediate escalation with the U.S. and China seems to be feeling the pain the most. However, technology, your top performer, financials are number 3, just down about 0.25%. On the downside, REITs down over 2%, materials down 1.6%, utilities down about 0.5%. Our market trend model going from pretty bad to very bad in a lot of ways. As of this moment, the long-term model is starting to change on some of those, potentially the mid caps and small caps. Again, I don't formally change the model until Friday after the close. So between now and then, we'll see what happens. But the medium-term model on the S&P, this is my main market trend model. Bearish on the short term and the medium term. That medium-term model has been bearish for just over a month now. And that's the kind of thing when I see that tells me, get out of the way, get defensive, and that's where I'm at. Until proven otherwise, I think the path of least resistance is lower. As we like to say, the market is guilty until proven innocent. On the downside, in terms of breadth, we can see about a 2-to-1 ratio of down versus up. Although in the New York Composite Index, a little bit more than that, 78% down on the New York Stock Exchange, only 21% higher. In the S&P, about a 2-to-1 ratio, 68% down, 32% higher. So generally, while the markets did kind of finish okay, and after that initial sell-off, they did recover going into the close, pretty much a down day in terms of breadth, I would say fair to say. Looking at the leadership or the previous leadership in the mega cap growth stocks here, the Mag 7 names, Broadcom the best, up 5.4%. NVIDIA having a decent day. Other semiconductors doing okay as well, up 3.5%. Amazon up about 2.5% today. And that's certainly helping within the consumer space. 2 days where we closed above the open on Friday and then again today on Monday. On the downside, Apple, as I mentioned, down quite a bit. So, I mean, the stocks that struggled today, stocks with direct ties to China, or that's a main revenue source. So Apple, that's obviously been a big part of the story there. So down another 3.7%. Tesla and other automakers really seeming to bear the brunt of the tariff news. These are the names and certainly the groups appearing to, face the biggest immediate downside follow through after the tariffs were announced. So Tesla, along with other automakers in the red today. So Tesla down about 2.6%. I think that's it for there. Let us go to the market carpet here and see how things are playing out. And apologies as always. I'm doing this from a house we rented with tech that I've just set up here, but hopefully you're able to see this, and I'm getting comments saying you are, so I'm so thankful for that. Technology is awesome, right? All right, let's look at the market carpet here. We can see, I mean, honestly, a very mixed day, right? When you look, sort of take a step back and look at the configuration here, overall, decidedly mixed, right? And you have names like NVIDIA, Broadcom, Amazon, Meta, all up a decent amount. Seems like a nice kind of classic up day. But then you have Apple, Tesla, Home Depot, down 2.5%, 3.5%. So it was a very much a bifurcated day, sort of all over the place. Now, again, remember, this was a very volatile session. This is kind of where we ended, but between the open and the close, it was a lot of movement. and a big down day became a big up day and settled into kind of the medium day across the board. General themes, though, I would say in the upper left, technology stronger than it's been here. I mean, post tariffs, technology and other growth sectors have certainly been struggling. In 2025, certainly since the February peak, technology has been arguably the worst sector to be in. Today, not a bad up day. And I would say you can see names like Palantir, a lot of the semiconductors like Applied Materials, KLAC, Lam Research, Micron, all having decent up days. So, certainly seeing semiconductors do pretty well. Now, if you zoom out of the chart of semiconductors, it's not good. So let's keep in mind that these are names bouncing off of fairly rough months that we're coming out of here. Other things to observe within discretionary, besides Amazon and Caesars randomly up today, everything else was down pretty good. And what concerns me about consumer discretionary, besides Tesla, which we mentioned, look at Home Depot, Lowe's, Starbucks, Nike. These are stocks that have been struggling. You're looking, instead of a bit of a bounce here, they're just continuing to roll over. So just selling off immediately. And I think as we get into earnings season, that's the concern, is that you have companies like this, really articulating the potential impact, because they're going to have to address what the potential impact is for tariffs and how they're kind of planning around that. I can't imagine a scenario that does, unless we see some big change in tariff policy in the next couple of days, which, I mean, granted, is totally possible in this world of random headlines that we're unable to predict. But everything I'm hearing is saying, nope, we're just continuing to double down on tariff rhetoric and aggressively going after other countries. And I think companies like Nike and Starbucks and Lowe's and others, we're going to hear the impacts, and it's not going to be good. I mean, I think that hurts the top line, that hurts the bottom line. There's no way that doesn't make things more expensive for U.S. consumers, at least for the foreseeable future. And I think all of that weighs on the markets until things change. So that's kind of the thought on consumer discretionary. Financials are interesting because when you look at this week, earnings season really starts on Friday. And if you think about it, the banks are where we start to get a lot of the earnings. So some of these names are going to start reporting on Friday. That'll be the beginning of this first quarter earnings season. And this will run through, mid-April through early May. And so the first reports we'll get are from some of these banks here. Today, some of those banks up, right? Bank of America up 3.5%. That's good. JP Morgan, Wells Fargo, both up about 2%. But a lot of red in a lot of other areas of that market, especially in a lot of insurance companies. And the insurance companies have been relatively decent places to be. A lot of those pulling back. I was looking at some of the exchanges earlier. I don't think I grabbed any of those, but like ICE and others that have had really good runs, really starting to pull back pretty aggressively. Obviously, elsewhere, you can see a lot of red in energy and certainly the defensive sectors like real estate, utilities, even materials. These are names that are just starting to roll over quite a bit. So short answer is this certainly felt by my read as in a choppy session. I don't think this changes the picture. I didn't see any, big changes where it feels like, okay, this is now a new week. This feels like a bouncy, choppy, volatile session. The VIX remains even more elevated than it did on Friday. I think this is a pause within a downtrend, and we're just waiting for the new future days to open, probably pushing us further to the downside would be my general assumption at this point. All right, I do see some questions coming in. I appreciate you doing that. I'll take a question or two, and again, thanks for like champions tuning into a very random late night timing. Apologies for that, but I'm prioritizing family a little bit this week. Always as much as I can, but especially this week, it's spring break, and so we're out in a remote part of Washington, so I'm getting to the show when I can. I appreciate you giving me the flexibility for doing that. All right, looking at the daily chart of the S&P 500 here. So here's the gap lower on Thursday. That was after the Wednesday, after market tariff announcements. There's the gap down on Thursday. There's the gap down on Friday. Here's today's open around 49.50. On an intraday basis, we traded down around 48.40. That overall is a 21% decline from the February peak to the intraday low that we saw today. Now, on a closing basis, we did regain about half of that of today's range. We did end up almost back to yesterday's close. So we ended up around 50.60. So we're down about 17.5, 18% off the February high. So we were down a lot more out of the open. Again, by the close, we'd gone much higher, but it ended up settling in around there. So we're still down quite a bit. Technically still above that 20% level. I'm less hard and fast about being above or below 20% as being an especially meaningful number. I think that's more of a headline thing. I think this is a correction. I don't care how you want to label it in terms of the percentages. This is a corrective move if I've ever seen one. So I'm calling it a correction. And at this point, I think this market is guilty until proven innocent. I think we have a lot of recovery to do beyond what I've seen today to assume anything like that. Having said that, we're oversold on the daily chart. We're also oversold on the weekly chart, which we have not done many times. Only a handful of those that we've seen over the last 5 years. And usually that has certainly led to some sort of bounce here and often a buyable bounce. In a protracted bear market, though, you can become oversold and just have little bounces off of those levels. So we'll see. A couple other charts on the S&P, and then we'll get to some other asset classes, then look at some individual stocks here. So looking at the breadth conditions, breadth obviously quite negative today after being quite negative over the last couple sessions. We're down to around 20% of the S&P members still holding above their 200-day moving average, which means 4 out of every 5 S&P names are below their 200-day moving average now. That is a bearish reading if I've ever seen one. We're down to less than 10% of S&P stocks above their 50-day moving average. Now, your brain is going to tell you that's probably a contrarian buy signal, and I don't blame you because that has often happened, right? When the indicator gets that low, particularly below 10%, that's where I immediately start to think, all right, at some point we get some bounce. So if I'm a swing trader, I get the argument of seeing that and betting on some sort of swing. I have to remember, though, the last time that happened was in December of 2025. That was here. We ended up going lower for the next 3 weeks before we eventually had the bounce higher into February. But that was coming after a big bullish run. We also got down to these, single digits here in October of 2023 before we bounced, and we ended up undercutting the 200-day and moving a little bit further before making that eventual low in the end of October. Now, I'm not going back to 2022, but you better believe this indicator gets down there. And even though you have these little bounces, those are short-term bounces within downtrends, right? That's what would happen in kind of a dead cat bounce scenario. So I think in this environment, you have to separate short-term counter trend signals. That means if you're looking for like a tactical rally, maybe that's an opportunity. But as more of a position trader, this is very much, these are conditions that happen really only in bearish phases. The very weak breadth, the very high volatility. We eventually hit some sort of bottom, but these are not bottoming signals yet in terms of my experience here. All right, looking at the bullish percent indexes, these are indicators that have gotten very, very bearish. And I will tell you, things I would look for on this chart would be the bullish percent index getting back above 30%. We broke below 30%, but now you can see we're almost down to single digits, which we've not actually seen. This is the lowest level we've seen since the September 2022 level, which was just before the October 22 low. So we're at extremely low levels. But again, that will happen in bearish phases. And even if we get bounces, doesn't necessarily mean the bearish phase is over. But if you look for when the indicator pops back above 30%, that's where you can often get a pretty decent sort of counter trend rally, at least to the upside. So now that we've gotten so low, this is a good chart to watch to look for a break back above that crucial 30% level. It's a pretty far ways away from where we're at today. And we would have to see a pretty good improvement in a lot of charts to actually see that signal play out. Now, what does this do for downside targets? Well, I had a couple downside targets. We've blown right past them like they weren't even there. One was sort of that 5,100, 5,150 range, and that came from Fibonacci support, the August 24 lows. That was right there. We've now obviously blown below there. And so the next level down is 50%, which is around 4,800. We actually got there on an intraday basis today. I mean, very, very close within a rounding error. I wouldn't be surprised if 4,500 is the end of this sort of corrective move. That would be obviously quite further. That's another 400 points lower on an intraday basis, 300 points on an intraday basis from today's close. That's another 500 points. That'd be another 10% drop to get down to those points. Based on what I'm seeing so far, I think that's a reasonable downside target. But we'll see what happens, right? And again, I think watching these short-term levels, these long-term levels, along with short-term measures of breadth and volume can help us quantify whether or not those are actually playing out. I am planning a YouTube video. Hopefully I can do that tomorrow, but again, we'll see what all I can get to this week. But I'd love to get a YouTube video out talking a little bit more about some of those levels and how we can project some downside objectives. I'll let you know if and when I can make that happen. Dollar index, kind of interesting, right? So the dollar rolled over quite a bit on Wednesday, then Thursday, Friday, the dollar actually started to rally a little bit. Particularly on Friday's session, we saw the dollar move higher. Now that's interesting to note, because one of the things that could be a really bad outcome of this whole tariff thing, and I would argue, to be clear, not a fan of how this is playing out at all. I see a lot of illogical outcomes with it. I mean, there's a lot of things that come out of it, a lot of bad side effects that I think may not be intended, but certainly seem to be happening. One of the unfortunate outcomes could be non-U.S. investors not coming back and investing in the U.S. And that has been one of the great parts of this bull market that we've experienced up until February of 2025. Has been, flows from outside the U.S. into U.S., which means you convert into U.S. dollars to buy U.S. stocks. We're seeing the dollar weaken quite a bit in 2025. Now, usually when the market gets really ugly like this, you see the dollar start to rally. That's what we saw in 2022. We've talked about we called it the wrecking ball of risk assets, because the dollar was working, kind of everything else was going down, because the dollar was going up, and that sort of implied non-U.S. investors, converting into U.S. dollars. You're not really seeing that. You saw that a bit toward the end of last week, but today we're actually seeing the dollar roll over a little bit. So I think one thing to watch is to see if you see an improvement in the dollar. I think that would probably mean, maybe less painful a drop in risk assets beyond what we've seen so far. But unless you see a good rally in the dollar, I think that could be a concern. Someone mentioned, by the way, I think on Friday's episode, someone asking about highlights from the CMT conference that I attended in San Francisco. And I did share quite a bit with my market misbehavior premium members on a number of those presentations. I kind of reserved a lot of the takeaways for them, but I will tell you that one of my favorite presentations there was Gina Martin Adams, who's the chief equity strategist at Bloomberg. She spoke on Saturday, and some really good comments. And that sort of description about the dollar, particularly with flow, she had a lot of great charts to provide a lot of further evidence about how that has worked in previous cycles. And that's really helped me to think about that particular area of the market. So appreciate, as always, hearing Gina's take on things. Some other sort of intermarket charts here to continue. Gold started to break down a little bit. Now, let's be clear, the chart of gold still in a much better technical position than any sort of equity indexes that I'm seeing at the moment, particularly U.S. Equity indexes. Note how the momentum is still overall positive. So the GLD did break below a trend line using the December low and the February low. So that's not great. We're still above the 50-day moving average. The RSI is still above 40. So compared to other charts, not bad. And the relative strength is still quite strong. I still own quite a bit of gold in my own accounts, and I'm not planning to change that anytime soon, because in this sort of environment, I'm pretty happy getting to things like gold and other sort of, traditional safe havens. I think those are good places to ride things out. From a tactical perspective, though, you are certainly starting to see gold come down along with risk assets out there. So some of the hard assets coming down, along with soft assets or paper assets. Note that silver was actually up today while gold was down. Now, crude oil, we had highlighted this chart because it looked like this really classic pattern. We'd seen this repetitive pattern of crude oil coming down, breaking above trendline resistance, powering above the 200-day, leading into another swing high, even though the longer-term trend was down. This is one of those charts where tariffs kind of changed everything. Now, we never got that follow-through above the 200-day moving average here, and that's something that I'm starting to really pay attention to. And again, that was Wednesday, Thursday, Friday, and again today, crude oil just accelerating to the downside. So again, I think a lot of charts getting a very different look from pre-tariff to post-tariff. Crude oil was one of those that really was looking to improve and really looked like it might push above the 200-day and essentially drive higher, but we never really got that follow through. And I think the tariff announcement has kind of changed that quite a bit. Crude oil oversold, actually, and it has not been oversold much over the last couple of years. I mean, you can see previous times we've been oversold. It's ended up being a pretty decent bouncing opportunity, something I'm looking for on the chart of the crude oil future. Treasury bonds, another thing that have changed quite a bit. There's Friday's session where we opened higher and closed lower. And we saw on both Thursday and Friday a higher open and a lower close. And even Wednesday of last week, you saw that. Today, we opened back within this coil pattern that we've highlighted. And we actually closed slightly below the coil pattern. So a potential dramatic change in the chart of bond prices, with the TLT going from a breakout above pattern resistance to now it looks like a failed breakout and a retrenchment back into that pattern, and now potentially a breakdown to the lower side. The momentum is still okay. The momentum is still more in a bullish range when you look at the RSI, but very, very close to changing to more of a bearish pattern, which could be a breakdown signal there. So what's rough is some of these areas of the market that did look like potential safe havens starting to change a little bit. Now, let's see if today was one day, right? Because you had stocks kind of gapping higher, trading higher a little bit, but ended up chopping around. Maybe that's just a short-term pullback before a resumption of the uptrend, but certainly a chart very much in play to watch. HYG is a chart to watch as well. Now, I do have a position in this in HYG in my own portfolios. It's down quite a bit. And from a technical perspective, would I be happier if it was not below the 200-day moving average? I would. However, even though this looks like a pretty ugly breakdown, which granted it is, even though the RSI is pretty weak, which it is, it's oversold and almost below 20. This is only a 4% drop from the February peak to where we're at today's close. Now compare that to the S&P down about 18%, and you can see why high yield bonds are pretty good. And you can see why the relative strength is accelerating so much. So even though it's come down, and on an absolute basis, it's not going up, it's going down a lot less. And those are some of the charts you want to look for. Things that are pulling back. And even with individual equities, I think this is a good way to think of it. A lot of things are breaking below their 200-day. As a matter of fact, most things are below their 200-day at this point. But look for things where the relative strength is improving. And that means you're basically going down a lot less than the S&P or the NASDAQ. And that's why high yield bonds are something that I've added to my portfolio in 2025 as an alternative to equities. Bitcoin continuing to trend lower. The momentum on Bitcoin is not great. We are now below the 200-day moving average. We had traded above it here, but closed below it at the beginning of April. Now we're continuing to push lower a little bit. The momentum overall pretty weak, and the RSI continuing to stay below 50. I think this chart is something you wait for a break back above 50, ideally above the 200-day moving average. Those are the kind of things I would look for. What's interesting, though, is in the last 24 hours, we've traded down almost exactly to a 61.8% retracement of the September 24 low to the December 25 high. We obviously retested that high in January, but now we've pulled back. We found resistance at the 38.2% level. Do we find support at the 61.8% level? In this kind of environment, at some point, things look cheap enough that you start to want to take a shot. I get the argument. If you want to take a shot here, I would just say, think of these previous swing lows, think of these levels as potential support levels. That's where you put your stop in. We break below that, and things are pretty ugly here. The fact that the momentum is still negative is why I would probably wait. If this is something I was a trade, I'd be waiting for a break above and momentum pushing higher before I would really get interested in it, but something to look for. And I do own Bitcoin in long-term accounts at the moment. All right, let's look at some individual charts. I'll take a question or two. We'll be done for the evening. NVIDIA actually having a candle pattern. Do you know this pattern? This is testing you if you know your candle patterns. Maybe this is one that you know. It's less common, but kind of an interesting one. This is called a bullish piercing line. That's where you're in a downtrend. You have a big down day, a lower open, but then a close that's at least halfway through day one's real body. If the close would get above that day's open, that would be a bullish engulfing pattern. So it's like a bullish engulfing pattern that didn't quite get above the previous day's open. That's called a bullish piercing line. And it's a bullish pattern. So it tells you the next 1 to 3 bars most likely higher. Candle patterns like this have a built-in stop. You use the low of that 2 candle pattern. So that's around 87, which would be today's low as the potential stop. If you would take a long position based on that 2 candle pattern, that's kind of how that would be used using strict candlestick analysis. So bullish candle pattern as we're coming out of the oversold region, maybe a counter trend bounce in NVIDIA through this week, but I think a break below 87, all bets are off. That's telling us we're going lower. Semiconductors had a pretty good day, up 3.5%. The trend is still pretty weak, right? So we see lower highs and lower lows. So to be clear, the bullish, short-term thing I'm talking about, I think at best that gets us a lower high before the next leg lower. I mean, the primary trend, I would argue, very clearly low. We're down. We're in a below 2 downward sloping moving averages. This is not an investment. I think at this point it's a trade at best, but something to pay attention to if you're trying to navigate these short-term price swings. Tesla, the question is, does it hold 220? I mean, overall, this is not a good chart. The momentum is weak. We've stalled out attempting to get above the 200-day moving average. It's come down, of course, post tariffs, along with all the other automakers, and the auto space is really getting hit pretty good with some of the immediate. I mean, I think that's the first group really, from what I've heard, really articulating the challenges you're facing in a world of these new tariffs and just the logistics of trying to make money in that new environment. Having said that, Tesla currently is sort of in a holding pattern between support, which we tested today at 220, between the 200-day moving average around 289, 290. So I think a break above or below out of that range could be pretty meaningful. Take two, it reminds me of like high yield bonds, right? I mean, we're down over the last week or two. We're kind of right within this range here. Here's a price gap that we saw at the beginning of February. Here's the resistance around 190 that we tested in November, December, January, February, before the gap higher. The gap, the upper end of the gap was around 195. We got almost down to there in early March. We've now traded back into that range. So this is where you could expect a bit of a bounce here. The momentum is not great, right? You're getting bearish divergences as we've seen in other times. So the only reason I'm happy owning a name like this, I don't at the moment, but if I did, is the fact that the relative strength is so good, right? Stocks like this that have pulled back into potential support levels, they're holding up, right? It's not down a ton from 220 down to 190. Like, that's not bad. And it's a lot better than the S&P 500, certainly over the last month or so. So I found this looking at a scan for stocks making relative strength highs, 3-month relative strength highs. Good list of potential ideas to look through if you're looking for stocks to own in this kind of environment. All right, one more. Travelers. So the insurance companies had been some pretty interesting charts, and a lot of them getting dinged, like Progressive is one we've talked about, pulling back pretty aggressively today. Travelers down about 3.5% today. What's interesting about TRV is it's really at kind of the point of no return. We're right at that level. Today, we closed below the 200-day moving average for the first time in about a year and a half. The last time we were below the 200-day was in November of 2023. So that's not good, but we are right at the January low, right around 230. So betting on a counter trend bounce as we're oversold, testing support, I could get that as a trade. Now, this is a stock that had failed to break out in going into the beginning of April, but was holding up better, which is why the relative strength has improved a little bit. I'm concerned about the breakdown in the insurance group, which has been a pretty good place to be so far in 2025. Further breakdowns on charts like Travelers all of a sudden make this a very underwhelming group from a technical perspective. All right, let's take a question or two. Whew. And then we'll be done. Pradeem, thanks for watching late night from wherever you're at. I appreciate it. I remember you had mentioned riding an overbought stock till it is no more overbought. In a downturn, will you consider buying once we come out of an oversold condition? Great question. I think I talked about that a little bit with one of these charts. I mean, I think when you're in a downtrend and you have things that are oversold, right? You have to remember there's a couple different things. There's the tactical sort of price swing kind of thing, right? So if I'm a swing trader looking for things that are overbought like this and bidding on a potential upside reversal of a short-term kind of tactical swing, 100% I would do that. I don't do a ton of swing trading. I do occasionally. And those are the kind of patterns I would look for. I probably look at like a 9-day or a 5-day RSI, look for things that are oversold, look at the things coming out of that oversold region. Great opportunity, great sort of approach to find things that have come down quite a bit, and you're going to get a potential bounce to the upside. But the real question I would say though is from that next time frame up, right? If you're more of a medium term or investor, more of a position trader, does the chart of Nvidia tell you that there's any dramatic change in the trend? And the answer is absolutely not, right? We're making lower lows and lower highs. The fact that we're at the oversold level at all just means we're going down quite a bit. So, the change of character happens when the RSI starts breaking above 60. That's what tells you, okay, we're now in a new uptrend phase, right? We're actually starting to recover where that medium term and the long-term time frame is starting to improve a little bit. So looking for stocks that are oversold, good for buying a bounce, good for a trade back up to resistance, buying up to a declining 50-day moving average. That's an interesting sort of trade to make, but differentiate, I would argue, a trade from an investment. And I would say these are not necessarily, investments to be thinking about just yet. Let's see, maybe one other question. Jeremy, thanks for watching on YouTube. Is the bearish diversion on the TLT daily chart? I think the divergence you're talking about, where it made a recent high on lower RSI, something to talk about. Yeah, let me go back to the chart of the TLT. Here it was a bearish oh yeah, right. So this one, yep, I see what you're saying. Is this a bad thing? It's not a good thing. And I will tell you, when this was happening, right? Well, and I think we talked about this. If not, this is something I remember noting in my in my own work. It looks kind of similar to this, right? Look at the peak in August and then September, right? So we're making higher highs on weaker momentum. That's a bearish divergence, which is often more of a longer term sign of a rotation, suggesting we're at an exhaustion point. Sure enough, bonds sold off for the next like 4 months. So the problem was at this particular point, though, it's hard to really declare it a divergence yet, because if we keep going higher and higher, it's no longer a divergence, right? So you have to wait for that peak to be locked in. But I think with today's gap lower, it really suggests that that's a higher high on weaker momentum. It certainly suggests a divergence. And that was, I was talking about, I think we're potentially, rotating lower on bond prices. And that's what happened in 2022. Stocks sold off, bonds sold off too. We just weren't seeing that up until today, right? I mean, through Friday, bonds are kind of rallying, rates are coming down. Again, what concerns me is a lot of the rhetoric I'm hearing from the White House is talking about, the Fed lowering rates. Now, that's not the long bond that they're lowering. That's the short end of the curve. But something that could be a part of this is maybe that's something that we hear more and more noise about. The 10-year yield is really driven by expectations about economic growth, and the fact that bonds are selling off like that and rates popping higher, sort of an interesting head scratcher today. Today was a weird session, I think, from so many ways. It's almost like you want to wait and see what happens tomorrow to see if this was just a one-day thing or a follow-through. But from a purely technical perspective, yeah, I think the bearish divergence is something certainly I'll be watching. I think the RSI breaking below 40 would kind of complete that bearish rotation. We'll see if that actually plays out. Hey guys, listen, thank you so much. Those of you tuning in live, I am so thankful that if you see my name pop up, you think it's something you want to watch. Thanks for that. And those that are watching on the YouTube channel as a replay, thanks so much as well. Please be flexible with me this week. We're on spring break. We're going to be doing some hiking, some snowshoeing. It all depends on the weather, because the weather in this part of the country, if you know Washington State, we're in the Olympic Peninsula. It's a rainforest, basically, with mountains and snow. It gets about 30, 35 feet of snow during the winter, but also a ton of rain. So it's raining where we're at. We're going to hike up in the mountains potentially, but it's all very volatile. So I will get to shows every day, ideally when I can. I'll try to keep you guys informed when it's going to be, but I appreciate you being flexible this week. Wish you well and a safe night wherever you're at. And remember, it's always a good time to own good charts. Have a good night, folks. Thanks so much.